Overall summary of what's going on in the globe. We saw during the financial crisis of 2008, the advanced nations were pulled down more so than the emerging nations. The advanced nations suffered a much more severe recession. The emerging nations did not face as much of a severe recession. These nations also exited the recession more rapidly than the advanced nations. Brazil exited more rapidly than other emerging markets, followed by China. And really, it was the emerging nations that helped pull the advanced world out of this economic quicksand after the financial crisis. And that was done primarily through the economic stimulus packages that were passed throughout the globe, which encouraged spending. Now, as I had predicted, shortly after the global economic stimulus was passed, I knew that this was not going to last beyond mid 2011. And as we see now, that is when we started to encounter problems. We saw problems in the Brazilian economy, and then we saw problems in the European economy. We also saw some problems in the Indian economy, and more recently we're seeing some pretty substantial issues in the Chinese economy. So what we saw in the first phase of this post-financial crisis so-called recovery period was a tale of two recoveries. We saw a more robust, rapid, healthy recovery from the emerging markets, and then we saw a less robust recovery in the advanced markets, the advanced nations. In phase two, we saw a more clear divergence in the advanced world. The U.S. began to distance itself from the European region in England. The U.S. economy was not really showing an absolute recovery, but relative to the lack of progress in Europe, it was looking substantially better. And of course, we also saw some periods of market turmoil, and that was during late 2010, 2011, 2012. We saw a flight to safety to U.S. dollar-denominated assets, U.S. stock and bond markets, U.S. treasuries. So now, since that time, I guess you could consider phase three, which is the more recent phase. We're seeing now the weakness in the emerging markets. Now, the weakness in the emerging markets really began arguably late 2010 or early 2011, but definitely began by mid 2011. Now, that early weakness was not that severe at all. It was very mild, but we did warn about that weakness. Since that time in 2012, the weakness in the emerging markets has continued to increase, and in 2013, really we've seen the collapse in the emerging markets, China, Brazil, India. At the same time, we're still seeing a continued weakness in Europe, but the U.S. economy continues to strengthen. So now we're seeing kind of a bifurcation of the recovery in the advanced world. Actually, it's a trifurcation, right? Because before we saw the U.S. distance itself from Europe, but even in Europe, we're seeing somewhat of a bifurcation. We're seeing the more advanced nations in Europe do a little bit better, although they have been pulled down by the weakness, the overall weakness in the EU. Even Germany, as we had predicted a couple of years ago, has been pulled down. But more specifically, in the European Union, we're seeing the northern economies, the northern nations, northwestern Europe do much better. Even more specifically, those nations that are not in the European Monetary Union, they have their own currency. But nonetheless, they're still in the EU, they're still going to be affected. Now, at the same time, we're seeing a little bit more strength in the UK relative to a couple of years ago. But still, once again, we cannot expect a whole lot of improvement in the UK because they are tied into the EU. Although they have their own currency, there's still a very strong trade relationship. So that's pretty much just a summary of what's going on. We continue to see strength in the U.S. economy. It's only relative strength, right? I mean, absolutely, if we look at the U.S. economy, it's still pretty miserable. But when we compare it to the risks out there, and we compare it to the progress or lack thereof made in Europe, we can see that there is some relative strength. Now, the bottom line is the employment situation has not improved in the U.S. at all. Most of the jobs, vast majority of jobs created have been in the restaurant and retail sector and other low-paying sectors. We still have about 9 million, conservatively, 9 million jobs that are not in the economy that should be there relative to prior to the financial crisis of 2008. And that is basically resulting in a loss of $1 trillion in the economy every year. The bottom line is that irrespective of the absolute weakness in the U.S. economy or relative strength, however you want to view it, the fact is that earnings continue to do well. This is something that the doctors of doom never talk about. The bottom line is it's about earnings. And earnings are not being substantially increased or boosted by quantitative easing. Quantitative easing is adding some small components to the stock market. It has pushed down treasury yields, thereby encouraging investors to pile into the stock market. Yet, if earnings weren't good, we would have seen a highly elevated P/E ratio in the S&P 500. We don't see that. If quantitative easing is causing people to go into the stock market due to the risk premium, the low treasury yields versus the relatively low risk in the stock market, then we would see excessively elevated P/E ratios. But the fact is the P/E ratio is about 15. It's not really elevated relative to the past 5-10 year period. Slightly elevated, not a big deal. And that means earnings are strong. It's been earnings that have driven the market. Now, one could say that a portion of the S&P has been elevated due to quantitative easing, and I would agree. And that portion is the financial industry. The financial industry, as I have continued to talk about for a few years now, has been benefiting from a bailout, the biggest bailout that you haven't heard about. And that's these essentially 0% interest rates, which have enabled banks to get free money and invest. At the very least, they can invest in U.S. Treasuries and collect the spread. That's the most conservative strategy. More aggressive strategy, they can just park their money into Brazilian banks. Right now, even though the Brazilian interest rates are fairly low relative to a couple of years ago, they're still about 9%. You can't create money out of thin air. It's coming from somewhere. Where is it coming from? It's coming from savers, those individuals who don't want to take the risk. They want to park their money in the bank, right? They're not getting paid because interest rates are so low. That's where the money is coming from. It's coming from savers, what they should be receiving to the banks. It's fraud. And more importantly, it's the pension plans. Pension plans are becoming more underfunded because of these low interest rates. I've discussed this ad nauseum. You're not hearing about it. It's a critical issue. So, overall, the U.S. stock market continues to remain strong. The only question is, when are we going to see a recession? Now, you've got a lot of clowns out there who are calling for a recession in the U.S. in 2014. Why? Well, because they're looking at history. They're looking at historical periods whereby the U.S. typically runs into a recession every 5 to 6 years, right? And so we're running into that period now. And so they're just basically making a guess. Well, you can't do that. You have to look at the data. I do not see a substantial risk of the U.S. slipping into a recession in 2014 at this point. Now, if we have a global problem, that's another issue. If China blows up, if their real estate market blows up, they have a hard landing. If there is a financial crisis in Europe, which is possible, then we're talking about a very high likelihood of a recession in the U.S. over the next several months after these things happen. But if we do not see these big events occur, then the chances right now of a recession in the U.S., I would say at least through the first half, are very slim. Now, keep in mind, of course, the U.S. economic growth is pretty tepid. It's not strong at all. But that's much different than a recession. And as I did forecast early in 2013, I discussed that we would see weakness in the second part of the year, 2013. That's exactly what we have seen. And that is in contrast to virtually every Wall Street firm, every economic body out there. They were discussing a strength going into the second portion of 2013. Federal Reserve as well, which once again highlights the fact that these guys are completely clueless. They have their heads up their asses. You cannot listen to them. And of course, the media goes to these sources. This is why you cannot listen to the media. At the same time, you can't listen to these doomsday clowns because they have an agenda to pitch doom, to pitch gold. Each side is a sales pitch. You have to stay away from these sales pitches. And I'll be discussing more of this in some videos for subscribers to the Intelligent Investor. We're going to get a lot more detailed over the next few months.